So, has the Reserve Bank gone soft on inflation? Is it spooked by the prospect of an economic slowdown or even a recession? Or is this the start of the soft landing for Australia's economy? Let's bring in here Phil O'Donoghue, who is the Chief Economist with Deutsche Bank in Australia. Phil, it's always good to talk to you about these matters. So there's the big question here. You know, the world headlines where the Australian Reserve Bank seems to have broken ranks with where others, hawkish, trying to beat inflation. Is that the reality?
Yeah, look, Ross was very surprised by the decision this week for the RBA to dial back. It is, as you say, entirely inconsistent with what we're seeing around the rest of the world. Look, I think the RBA is trying to suggest that it's getting close to an end for this hiking cycle. Look, I think when we look around the rest of the world, though, the evidence suggests that possibly this might be a bit premature from the RBA, that we might have to see more aggressive hikes and potentially this dialing back so relatively early compared to other central banks might ultimately mean that the RBA actually has to do more rather than less down the long run.
OK, because there is enormous pressure on the Reserve Bank. There's already an inquiry into its role and function and the way in which, you know, its settings are actually, you know, whether they're appropriate for Australia's economy. Then there's also previous decisions of the Reserve Bank where it was slow to recognise the inflation risk, certainly compared with New Zealand, for example. And as a result, it was highly criticised when it had told people that it wasn't going to move interest rates up until at the earliest next year sometime. So in this, I wonder what sort of pressure, political pressure, is on that Reserve Bank board right now.
Yeah, look, I'm not convinced that this is political pressure that the governor is seeing. I think he is very conscious that here in Australia we have, mortgages that are driven at variable rates. So every time the cash rate changes, we see an instant reaction, instant change in mortgage interest rates, and that's not the case elsewhere in the world. So. And I think what we're getting from the RBA is an alertness to that sensitivity. I don't think it's a political issue. I think, though, that perhaps we're going to see that sensitivity from the household sector perhaps isn't quite as acute as the RBA is thinking. It is being very cautious here. It's not clear to me, though, when inflation is as acute as we've seen at any point through the inflation targeting era. It's not all that clear to me that cautiousness about how households respond should be the ultimate or the overriding consideration here. My sense is the RBA should probably be a little bit more concerned about just that headline rate of inflation, the risk that it accelerates more than they expect, and should be a little bit more focused perhaps on getting inflation back to target rather than these kind of secondary concerns about how the household sector is going to respond to higher interest rates. OK, so in the week
or so before this Reserve Bank decision, there'd also been a situation in the UK where you saw, if you like, a softening, a U-turn on tax cuts. And that really caused a crisis in the pound, a crisis in the global markets as a result. Now, what I'm just wondering is whether here the Reserve Bank maybe dialed it back because it's fearful of some sort of economic downturn, that it doesn't want to hurt the household sector or the business sector for that matter. And that might have actually been part of the backdrop of the decision making to not go even more aggressively with these interest rate rises.
Yeah, look, possibly. As you know, the UK, we've seen some extraordinary reactions in the last week or so, a little bit over a week, in terms of financial markets reacting to a fiscal pivot from the UK government. Look, I think that is very idiosyncratic for the UK. Yes, it's led to a lot of financial market volatility, but I don't think there's a great deal of read-through for here in Australia and for the RBA. Look, the global economy, there's been a lot of uncertainty. There's been a growing risk of recession globally. It's not clear to me that over the past month that story has changed sufficiently enough for the RBA to be dialing back. I don't think that there's been enough concern, even with that uncertainty. I don't think concerns have elevated enough over the past month. And in fact, if anything, we actually look at the US data, real activity data has actually been holding up a little bit better out of the US than perhaps you might have been expecting a month or 2 months ago. So, yeah, look, the UK, pretty idiosyncratic. But again, I don't think those recession risks are any greater than they were a month ago. And the bottom line is, commodity prices remain elevated. Australia uniquely or relatively uniquely amongst developed economy amongst developed economies is gaining. You know, we're getting a benefit, national income benefit from those higher commodity prices. So, yeah, for mine, I think eyes should remain on inflation. Still concerned that we're going to see higher rather than softer inflation over the period ahead, and that's where the RBA should be focused.
And the evidence is here in Australia, the Reserve Bank says it is prepared to continue to raise interest rates. But the fact is that all of the evidence, retail sales, consumer confidence, the fact that even if we look at mortgage clearance rates, auction clearance rates, all very strong. So these things indicate that there's been a level of being able to cope with the higher interest rates to date, notwithstanding inflation that's broken out in Australia.
That's exactly right. You know, the latest data we've got on restaurant and takeaway services is at a record high. Discretionary spending remains very, very strong. Here we are almost 6 months into the RBA's hiking cycle. So, you know, the early evidence, and it is early, you know, it always takes some time for households and businesses to react to higher interest rates. But the early evidence is, as you say, one of resilience. And that, you know, that unfortunately for the RBA, that's not what they want. What they need is to actually get slower activity, get weakness in demand coming through the economy to get that inflation back out of the system. So, you know, so far, while it's encouraging for the economy, good for employment, good for tax revenues for the government, potentially not so good for the RBA's inflation target.
It's going to be interesting to watch it. Phil O'Donoghue, always good to have you in the program. Chief Economist with Deutsche Bank. Many thanks for your time.